Okay, so the Indian investor has now woken up to the fact that he needs to have global investments in his portfolio. And you guys at Mire have a lot of exposure and expertise in global markets, especially now the South Korean market is doing fabulously well. Taiwan has been doing well. Tell me, if someone has zero exposure to international investments, how do they start? Because a lot of the funds, you have, they're trading at a premium. There are these feeder funds which are very expensive. So it's not very easy to invest in global markets. So give me a 101 strategy.
See, I think first of all, the first global strategy has to be the dollar, because that's the widest acceptable currency. So investing in US should be the first port of, a first destination. At this moment, the objective of any portfolio, forget global or Indian, should be to diversify as much as possible, to own different set of businesses. When you look at the businesses available in those markets, especially energy, AI, innovation, robotics, our house call is global defense. Okay, those are places, and everything has an ETF there.
So how do you invest? Because
So unfortunately, what's happened for us when we started this, our entire ETF business, we thought we'll bring the plethora or the might or Mire Asset global investments avenues to India. But then the stoppage of mutual funds there has stopped that plan. So we started something on the Gift City. And a Gift City portfolio on our global outbound sits exactly where India is not. It invests a little bit in China, Greater China. In the US, we catch these futuristic trends of AI, robotics, innovation, defense, whatever you call. So give a complementary portfolio to what it is in India. Unfortunately, those come at a different threshold. We're trying to convert it into a retail fund. Maybe as we are not very confident of the back end of service there. So once we build that, we'll send
what's
it.
the minimum investment for that?
So it starts at $50,000. So that's a different threshold. So becomes a little
Inaccessible to retail, yeah.
But once we bring it down to, and we'll bring it down to $5,000 is our plan. But once we do that, then it can be available to a broader sort of thing. But apart from that, there are some very good stories outside Mire, which time and again open out for subscription from various funds. I would definitely advocate the young to read up a bit, and it's no rocket science. Just do a little bit of basic studies on what those, and back yourself in taking those sort of calls on investing there. There are some very good distributors, advisors out there who can guide you.
So you're saying the best way to invest is through Gift City?
Right now for us, because our funds are closed, we have two beautiful funds called Fang Plus. That's my favorite. As employees, we are waiting for some redemption to happen there so that it'll open up a bit for us to buy. Nobody is redeeming Fang Plus. It's so spectacular to see people holding on, and that money continues to create money consistently. And when you look at the next 2-3 years, those 10 stocks are looking pretty good going forward too. But that's been the behavior. People who bought in early and have held on have really benefited from this entire growth of the US market. But unfortunately, both our S&P Top 50 and Fang Plus are closed for purchase. And it'll only open if people redeem. I'm so happy that people are not, and just they're enjoying this incredible ride of what's happening.
So for a young investor today, what do you feel? How much percentage should be in domestic markets? How much in international markets? And what should the overall asset allocation strategy be for this year?
See, asset allocation is a very personal thing, right? Asset allocation is about finding yourself. Before you come to asset allocation, you start thinking about what you want from your investment, right? And you can define what you want from your investment by starting with your income expenditure statement. I would ask how many young, old, whoever maintain an income expense statement on a monthly basis. Till you don't know that, you actually don't know how much money you need for your own spending, how much out of that you can invest, right? So it starts from that basic. Once you do that, today the young's need are very different from my need. And the world is at their feet. So just write down some of your needs or wants. Don't confuse your needs with wants, right? But segregate them. And there's nothing wrong in wanting the world. So put that. From that, then you'll know when you need the money. Once you have that duration, then you'll know what is your return requirement. Once you know the return requirement, then you can form a portfolio or what you call asset allocation. If your return requirement is 6%, the bank FD will give you 6%, right? But till you don't know that return, you cannot form your portfolio. So finding that is no rocket science, it's just a little bit of Excel maths. You need this money this much. Sometimes you will realize by doing that math that you don't have enough money. Maybe your dream is wrong. Then it will urge you to work harder to that dream, right? If that's your dream, right? But putting that dream is very important. From there you form. Now suppose somebody wants, say, 10, 15 lakhs in 4, 5 years. India is a growth economy. Still, irrespective of whatever, even after the oil thing, we're going to grow at 6%, right? You take out 50% of, that's how I look at it, whether it's wrong or wrong. That's how I do my math. 6%, 50% of GDP, which does not contribute, meaning actual growth will be 12%. So the projection from equity should be 11 to 12%. If you come to an active manager, you should expect 1 or 2% more, not more than that. Right. So 12, 13%, you can still look at a good part. Debt on an average 6, 7%. Traditionally, gold, thanks to the good run, is also at 13, 14%. A mix of that becomes your portfolio allocation. Please understand the multi-asset strategy has a higher probability of giving you a median return than a single asset strategy.